All right, folks, we're going to get started. Welcome back, everybody. Post the second exam. This is a kind of a bittersweet time of the semester. We're almost done, but it's a good thing and a bad thing. We have a lot to get through today, so I want to get right to the material. But as far as the exam goes, I'll talk about it at the end of the class when I pass back the exam. And again, that's at the very end of the class. So today we're going to cover Chapter 14. We're going to finish covering Chapter 14, which we started on last week, having to do with money, banking, and the Federal Reserve System. So we were talking about determining the money supply, how the money supply is determined based on movements within the banking system of like currency into deposits, and then part of that being saved as reserves by the banks, and then that getting recycled into the economy. So we'll talk about that whole process once again. Then we'll talk about the Federal Reserve System, our central banking system, a super important institution that has a lot of influence over the way the economy runs. And every country has one. It's worth your time to really understand how this works, because you want to be exposed to this information again if you don't take any more economics courses. But throughout your lives, you will be affected by the Federal Reserve. So it's a good idea to kind of just understand it, how it works, its nature, etc. And then we'll quickly talk about the evolution of the American banking system, how we went from not having a Federal Reserve to having one, and then a bunch of regulations and policies that we have today, which allow us to then stabilize the economy as much as possible with the monetary policy tools. Then we'll jump into Chapter 15, which focuses specifically on monetary policy and how that monetary policy is carried out. So like most things in this course, we have a model for understanding the effects of the expansion and contraction of the money supply on how the economy is performing. So we'll talk about that by this model called the liquidity preference model, which has to do with money demand and money supply. So first we establish the demand for money, and then we interact that with the supply of money, which is set by the Federal Reserve Bank. So it's a pretty standard sort of inelastic supply. It's a vertical supply curve that is independent of the price. It's just something that is set independent of price based on what the Federal Reserve Bank wants to do with respect to the entire economy. So we'll talk about how that works. And then we'll just talk about monetary policy and aggregate demand, the connection between those two things. And then we'll finally talk about money prices and output in the long run, how all these policies and the metrics that we are studying sort of play out in the long run versus the short run, as is always a point of interest in economics in general. How do things change in the moment, in the short term, when we're using our policy tools versus the long run? Are they effective? We'll talk about it. All right, so previously we talked about what money means in general. Money is any asset that can easily be used to purchase goods and services. Money consists of cash as well as other assets that are highly liquid that can easily be turned into money to be used to buy goods and services. We have the currency in circulation. That is just the cash that is held by the public. We have checkable bank deposits. Those are, of course, the bank accounts on which people can write checks. Both of them are considered money. And then we have ways of sort of measuring how much money there is. And money supply is a way of sort of defining how much of the currency in circulation and checkable bank deposits there are in the economy. It's the total value of financial assets in the economy that are considered money. But we have other measures of money, and then we'll talk about it again in a second, even though we went through it last week. Money in general has three roles. It's a medium of exchange. It's an asset that individuals acquire for the purposes of trading goods and services rather than for their own consumption. The second purpose of money is as a store of value. It's a means of holding purchasing power over time. You can set purchasing power aside and then, access it when you need it. And third, it acts as a unit of account. It's a measure used to set prices and make economic calculations. We talked about the types of money and how originally money was just like the good that had value. So gold and silver were often used as money themselves. But then we got to the point where people were storing a lot of gold and silver in banking institutions, and they weren't always requiring them. They weren't always withdrawing their gold and silver, and so then the owners of the banks realized, well, then I could actually lend out more money than I actually have on hand, and so then they started issuing these banknotes, which were commodity-backed money. It was a medium of exchange with no intrinsic value. It's just bills that said you can trade this in for gold or silver, whose ultimate value is guaranteed by a promise that it can be converted back into valuable goods. And then finally, we went away from the commodity-backed money to just what's called today fiat money, a medium of exchange whose value derives entirely from its official status as a means of payment. Again, it is something that we accept to be money because we know that there is a system of institutions and laws that support its value, our government, and that is enough to establish it as having the kind of value that we need in the money that serves the three purposes I mentioned. Now, as far as like sort of measuring the amount of money in the economy, we use what are called monetary aggregates, an overall measure of the money supply. The Federal Reserve Bank, the central bank of the United States, has two main ways of tracking the amounts of money that in the economy, and they differ strictly on how money is defined. So M1 is the narrowest definition, and that's where you find the money supply, checkable bank deposits, and currency in circulation. But you also find traveler's checks in there, even though they make up a very small percentage, in this case 0%, as compared to 44% of currency in circulation and 56% of checkable bank deposits. So that's M1, the narrowest definition, including monies that are the most liquid. And then we have M2, which includes what are called near monies, which are financial assets that can be directly used as a medium of exchange, but that cannot be used directly as a medium of exchange, but can be easily converted into cash or checkable bank deposits. So that includes savings deposits, time deposits like CDs, certificates of deposit, which are basically deposits that you guarantee you will not withdraw for a given amount of time from the bank, and they pay you a higher interest rate than a normal checking account or savings account as a result of it. And then we have also money market funds. Money market funds are mutual funds that invest only in liquid assets and bear a close resemblance to bank deposits. So M2 also includes M1 and then these other form of near monies. So 24% of it is made of M1, and then the rest, a lot of it is made up of savings deposits, and then of course money market funds and time deposits. All right, let's talk. We also talked about the monetary role of banks last week and how banks sort of operate. So banks are required to have bank reserves. It's the currency banks hold in their vaults plus their deposits at the Federal Reserve Bank. How they keep track of their assets and liabilities is via these T accounts. A T account is a tool for analyzing a business's financial position by showing a single table where you have the business assets on the left and the liabilities on the right. For a bank, the liabilities are the deposits of their customers because they have to pay those back. People will eventually withdraw those monies. And then their assets are their loans and their reserves. So again, the reserves include both the money they have at the Federal Reserve Bank and the money that they have in their vaults. And then, of course, the loans are also assets because even though they don't have the money on hand, they have a contract that states that you, the customer, will pay them back with interest. And so those have a value as assets. So the Federal Reserve Bank requires that all banks have a certain fraction of deposits held in reserves, and so that is what's called the reserve ratio. It's generally around 10% of the liabilities. So we see here the liabilities of the bank. The deposits are $1 million, therefore the reserves are $100,000. All right, we talked about the problem of bank runs and the issue where even though banks are able to lend out money because not everyone is always withdrawing their deposits, there are those times where people can get nervous and therefore have most depositors try to withdraw their funds. When that happens, you have what's called a bank run, a phenomenon in which many of a bank's depositors try to withdraw their funds due to fears of a bank failure. Bank runs can be contagious. We've had a lot of financial crises throughout history in this country and the world that resulted from instability within the banking sector, and that led to bank runs. During the 30s, we had some pretty bad ones. The United States and most other countries put into place a system designed to protect depositors and the economy as a whole against bank runs. The first thing they established was called deposit insurance. So we have the Federal Deposit Insurance Corporation, the FDIC. It guarantees the first $250,000 per depositor per issued bank. So if a bank goes under, the FDIC will pay you your deposit. They had to pay out some depositors during the 2008 banking crisis when some banks failed. But the main purpose of it is just to quell the fears of not being able to withdraw your funds and therefore halt bank runs. Another thing that was instituted is called capital requirements. So the excess of a bank's assets over its bank deposits and liabilities is called the bank's capital. So in this case, we have $1 million in liabilities and we have $1,300 in assets. So we have $300,000 above the liabilities, which is in this case 23% of the total value of its assets, which is equal to the bank's capital. So in practice, bank's capital is required to equal at least 7% of the value of their assets. We also have they also instituted, in order to sort of try to control and rein in the uncertainty of banking, reserve requirements. I mentioned the reserve ratio, the amount of reserves that banks need to have above and beyond their as a portion of their liabilities. So again, the reserve requirements are rules set by the Federal Reserve that determine the minimum reserve ratio for banks, and currently it's about 10%. And we also have what's called a discount window. It's an arrangement in which the Federal Reserve stands ready to lend money to banks in trouble. So the Federal Reserve Bank is known as the lender of last resort. If banks are withdrawing money from the Federal Reserve Bank, then we know that they're in trouble. But if they're in trouble, they have a right to borrow from the Federal Reserve Bank, and therefore, again, quell the fears of failure, which then helps to halt the propensity for bank runs. All right. Then we talked about how the money supply is determined via a multiplier process. The multiplier process is similar to the multiplier process we talked about when we're talking about GDP, but this has to do with the amount of money in the economy. So we looked at this example where there was some money kept under a mattress. Let's say there was $1,000, and whoever was keeping it under the mattress finally was like, I'm going to deposit this money in a bank. So they deposit the money in the bank. Well, this is the initial stage where the money is not deposited in the bank. So there's $1,000 in currency in circulation. So the money supply, which again is made up of checkable bank deposits and currency in circulation, when the money was kept under the mattress, is $1,000. Then they decide to deposit that money, $1,000, into the bank. So the bank has a reserve ratio of 10%. They need to keep 10% of that money, and then they could lend out the $900 extra dollars. So they lend out that extra money. So the currency in circulation increases by 900. We've got the checkable bank deposits that are the $1,000 that were deposited by the person that had the money under the mattress. And so therefore the money supply increased to $1,900. The people that borrowed the $900 went out, bought stuff at Best Buy. Best Buy then deposited the $900 in the bank again. And so The bank obviously has to keep 10% of that, so they keep $90, and then they lend out $810. The $810 then is added to the existing $1,900 in the money supply, again, which is that initial $1,000 and then the $900 that was then deposited after being lent out. And so we have $1,900 in checkable bank deposits, $810 in currency in circulation, and that winds up equaling $2,710. So this process continues on until eventually there is no more to lend out because the money is completely extracted. So we can track that and sort of see how the final impact of an increase in the money supply grows the entire money supply. So in reality, some of the loan funds, so something to consider is that some of the loan funds aren't always deposited right away or maybe ever deposited. Some people do wind up saving the cash, putting it in under their mattress or wherever, keeping it in their wallets. So economists say that some of the loan amount leaks out of the banking system and reduces the size of the money multiplier. For simplicity, though, just for the sake of understanding the concept, we'll assume that this does not happen right now. We'll also assume that the banks are required to satisfy a minimum reserve ratio of 10%. And we will also assume a bank lends out all of its excess reserves. And a bank's excess reserves are the reserves over and above the required reserves. So if they have $1 million deposited, they only require to have $100,000 in reserves. That means they will lend out the $900,000. That's what we're assuming. We're assuming they're not just going to sit on it. We're going to use RR for the reserve ratio, so it's 10% in this case. So RR equals 10%. The total increase in checkable bank deposits that is generated when a bank lends out $1,000 in excess reserves is going to be. So let's look at the increase in checkable bank deposits from that $1,000 in excess reserves. So the first round, again, you've got that $1,000, and then again, it's deposited back into the account of the banks, and the bank then lends out 1 minus the reserve ratio, so it lends out again that $900. Round 3. So you wind up with this amount again being deposited in the banks, and then that again is being multiplied by the reserve ratio. So we multiply that once again by the reserve ratio. Again, this is that first round, $1,000 deposited multiplied by 1 minus the reserve ratio to get the amount that's going to be lent out again, and then that money is deposited again in the banks, and then that money is multiplied by 1 minus the reserve ratio to figure out, well, how much of this money is going to be lent out. So we wind up with 1,000 times 1 minus the reserve ratio squared. That amount goes back into the economy, gets back deposited into the bank. And so then you've got that amount in the bank. Again, it's multiplied by 1 minus the reserve ratio. So you wind up with 1,000 times 1 minus the reserve ratio cubed that will be lent out in that fourth round. And then that goes on and on and on. Adding up these deposits for an infinite amount of rounds will result in a final amount of checkable bank deposits from the $1,000 in excess reserves to be 1,000 divided by the reserve ratio. So that is what the money multiplier winds up being, 1 over the reserve ratio. And in order to figure out, again, the final amount of checkable bank deposits that increase from an excess amount of reserves of, again, in this case, $1,000, but it could be any amount. You divide that amount by the reserve ratio, which in this case is 10%. So we have 1,000 divided by 10%, 0.1, which equals $10,000. So that $1,000 deposit will wind up increasing the money supply, which is made up of currency in circulation and checkable bank deposits. That's what makes up the money supply. It ends up increasing the money supply to $10,000. All right, so that's sort of an abstract way of understanding the money multiplier process and how we can gauge the impact of an initial round of currency that is introduced into the economy. But let's look at it in reality. So in reality, the determination of the money supply is a little bit more complicated because, of course, there is some of that leakage that I mentioned. So we've got this other thing that we talk about. It's called the monetary base. So you've got the monetary base and the money supply. They're two important measures of how much money there is in the economy. The monetary base is the sum of currency in circulation and the bank reserves. So I mentioned that the bank reserves are not considered as part of the money supply. The amount of reserves that the banks hold at the Federal Reserve and the amount of cash they hold in their vaults, that is not considered part of the money supply, but it is considered part of the monetary base. Currency in circulation is considered part of the money supply, and it's also considered part of the monetary base. To define the money multiplier in practice, it's important to recognize that the Federal Reserve controls the monetary base, but it does not control the allocation of the sum between bank reserves and currency in circulation. So in the example that we've been tracking, the cash from under the mattress went from currency in circulation to bank reserves, leaving the monetary base unchanged. So the monetary base is different from the money supply in two ways. So here we have this Venn diagram that kind of tells us exactly what we're dealing with here. We've got the money supply here in this large circle that is made up of checkable bank deposits and currency in circulation. And then we've got the monetary base, which is made up of the smaller circle, which again has the overlap of the currency in circulation and includes bank reserves. So again, the monetary base is different from the money supply in two different ways. One, bank reserves, which are part of the monetary base, aren't considered part of the money supply. And two, checkable bank deposits, which are part of the money supply because they are available for spending, aren't part of the monetary base. So our Federal Reserve Bank controls this, and then via the money multiplier we get this. So then that overlap becomes part of our money supply, and so this becomes sort of the base of the money, and this becomes what it multiplies into. So in practice, most of the monetary base actually consists of currency in circulation, which also makes up about half of the money supply. So then officially, the money multiplier is the ratio of the money supply to the monetary base. It's how much of this there is in relation to how much of this there is. And of course, this will be smaller than this. So this will multiply by a certain factor to get us to this. So the multiplier in practice is roughly about 1.6. It just depends on what's happening in the economy, but it's roughly around that magnitude. All right, now let's talk about the Federal Reserve System, this central bank that is such an important institution that most of us know nothing about unless you take a macroeconomics course. So a central bank in general is an institution that oversees and regulates the banking system and controls the monetary base. The monetary base, again, includes the currency in circulation and the reserves, the bank reserves. So let's talk about the structure of this Fed, this central bank, the Federal Reserve. The Fed was created in 1913, so it's a fairly new institution within the United States. It's not exactly part of the U.S. government, but it's not exactly a real private institution either. It's kind of like this weird public-private hybrid, and that is meant to sort of protect it from politics. So now we're having a political transition in our country, and the structure of the Fed, and that I'll talk about in a second, is meant to sort of shield the Fed and their policies from anything that's happening throughout the rest of the government. The Federal Reserve System consists of two major parts. One is the Board of Governors, and the other is 12 regional Federal Reserve banks. The Board of Governors oversees the entire system from its offices in Washington, D.C., and is constituted like a government agency. So that's the Board of Governors. It has 7 members, and they are appointed by the President of the United States and must be approved by the Senate. So that's the government part of it. They do have an influence over who these members are. But they are appointed for 14-year terms in order to insulate them from the political pressure in their conduct of monetary policy. So they aren't short-term thinkers. They don't have to worry about what's happening in the next election. They can just focus on what they have to do as these like monetary agents. The chair of the Fed is appointed more frequently. The chair is appointed every 4 years. Currently, we have Janet Yellen. She's the 15th chair of the Fed. She assumed office in February of 2014. She's the first female to lead the Federal Reserve System, which is pretty cool. It's traditional for chairs to be reappointed and serve several longer terms. Alan Greenspan, a name you may or may not have heard, was appointed in 1987 and served as the Fed's chair until 2006. So he kept being reappointed 19 years in that office. There's a lot of respect for him, but people sometimes feel that his policies are what led to the 2008 crash. So it's kind of a mixed bag right now. Okay, so there's also, remember this, so there's the Board of Governors and there's the 12 Federal Reserve banks, each that serve a region of the country, and they provide various banking and supervisory services. So we've got San Francisco, Dallas, Kansas City, Minneapolis, Chicago, St. Louis, Atlanta, Richmond, Cleveland, New York, Philadelphia, and Boston. And then you've got the Board of Governors in Washington, D.C. We only get the Federal Reserve Bank in our side of the country. So one of the jobs of these Federal Reserve banks is to audit the books of the private sector banks to ensure that they have a strong financial health. So, so that banks aren't acting too risky and that they are meeting their reserve requirements and their capital requirements. Each regional bank is run by a board of directors chosen from the local banking and business community. The Federal Reserve Bank of New York plays a special role. So the New York Fed is probably the most important of all the Federal Reserve banks. It carries out what's called open market operations, which are the main tool of monetary policy. So we'll talk very specifically about that in a bit. Decisions about monetary policy are made by what's called the Federal Open Market Committee, which consists of the Board of Governors, the 7 Board of Governors appointed by the President, plus 5 of the regional bank presidents. So 5 of the 12 presidents also serve on the Federal Open Market Committee, which again is the committee that decides monetary policy. The president of the Federal Reserve Bank of New York is always president. So the president of the Federal Reserve Bank of New York that is in charge of the open market operations is one of the 5 presidents in the Federal Open Market Committee. And then the other 4 seats rotate among the 11 other regional bank presidents. The chairman of the Board of Governors normally also serves as the chairman of the Open Market Committee. So Janet Yellen also serves as the chairperson of the Federal Open Market Committee. She's the head of the Fed and is the head of the board that decides monetary policy. All right, let's talk about specifically what the Federal Reserve does. So they can affect the reserve requirements and the discount rate that I mentioned earlier as being one of the options for banks to help sort of stabilize them during tough times. They can borrow from the Federal Reserve at a certain interest rate, which is the discount rate. So the Fed has 3 main policy tools at its disposal. It can affect the reserve requirements, it can affect the discount rate, but more importantly, and really the only tool that they wind up generally using, is their open market operations. Banks that fail to maintain at least the required reserve ratio on average over a 2-week period face penalties. As a result of that, they end up borrowing money from each other when they're not able to meet the reserve requirements in what's called the federal funds market. So again, in order to have that 10% that they're required to have of their checkable bank deposits, they are able to borrow from each other. They're usually overnight loans, pretty much literally overnight loans, like they're usually paid back the next day. And the rate at which they are borrowed, at which the funds are borrowed, plays a big role. So again, the federal funds market allows banks that fall short of the reserve requirement to borrow funds from banks with excess reserves. So we mentioned in our example that banks weren't lending out their excess reserves, but in general, they will sometimes have, we mentioned in the example that they were lending out all their excess reserves, but in reality, banks don't lend out all their excess reserves. They do sit on their reserves if they exceed the required reserves, and they don't really have enough incentive to lend out, or they feel that things are a little bit volatile and they don't really want to lend out, so they'll sit on their reserves a bit. And other banks may be more willing to lend out, but therefore they will fall short in terms of their reserve requirements, and therefore they will need to borrow some excess reserves from other banks in the federal funds market. The interest rate in this market is determined by the supply and demand. The supply and demand for bank reserves are both strongly affected by the Federal Reserve actions. So it is this interest rate that winds up being sort of the main tool of the Federal Reserve. We'll talk about how that works later. But it's called the federal funds rate. It's the interest rate determined in the federal funds market. This rate plays a key role in the modern monetary policy, which we'll talk about after the break when we get to chapter 15. So alternatively, banks in need of reserves can borrow from the Fed itself, so they can borrow from each other, or they can borrow from the Fed itself, as I mentioned, via the discount window. So then there's this other interest rate called the discount rate, the rate at which the Fed is willing to lend money to banks directly. Normally, the discount rate is set 1% above the federal funds rate in order to discourage banks from turning to the Fed when they're in need of reserves. So again, it's about kind of forcing banks to kind of do things amongst themselves via the federal funds market and staying away from the discount window, because again, the discount window is like a lender of last resort type of option that sends a very strong signal to the economy, to depositors, that the bank is in trouble. So they want the banks to avoid that option as much as possible. As a result of the 2008 financial crisis, though, the difference between the two rates shrank to 25 percent points. So generally, it's a percent point above the federal funds rate, the discount rate, but during the crisis, it wound up shrinking. In the summer of 2014, the discount rate was only 0.65 percentage points above the federal funds rate. So it did start to sort of get back to what it is normally, but it hasn't rebounded completely because, again, we had a pretty severe period, 2008 and beyond, that required extreme measures and that required lowering a lot of rates in order to encourage banks to borrow and then lend. And so that's why the spread between the two rates wound up getting smaller, but it is rebounding a bit. So in order to alter the money supply, the Fed can change the reserve requirements, right? If they change how much banks are required to have, if it's less than 10%, then that means they can lend more money out, which means via the multiplier process, there can be more money in the economy, or vice versa. If they raise the reserve ratio, they lend out less, and therefore there's less money in the economy. So that's one thing they can do. They don't often do it. The discount rate is another thing they can do. If they lower the discount rate, then banks can borrow more from them, and they can lend out more, and then there's more money in the economy. If the Fed, again, reduces the reserve requirements, banks will lend a larger percentage of their deposits. If the Fed reduces the spread between the discount rate and the federal funds rate, the cost to banks of being short of reserves falls. Banks respond by increasing their lending, and the money supply increases via the money multiplier. Under current practice, though, the Fed doesn't use changes in reserve requirements nor the discount rate to actively manage the money supply. So that's not their main monetary policy tool. It is the open market operations, which we'll talk about right now. So the Federal Reserve has assets and liabilities as well. The Fed's assets normally consist of holdings of debt that's issued by the U.S. government. So the U.S. government issues debt in the form of bonds. They can issue bills. Bills are government debt that have a maturity of less than a year. They can issue notes. Notes generally have a maturity between 2 and 10 years, and they can issue bonds, which have a maturity that goes beyond that, generally to about 30 years. So mainly U.S. Treasury bills, the less than 1 year maturity debt instruments, these again called U.S. Treasury bills, which again are short-term U.S. government bonds with a maturity of less than 1 year, are mainly the assets that are held by the Federal Reserve Bank. The Fed's liabilities consist of currency in circulation and the bank's reserves. So the bank's reserves, again, banks have to hold 10% of their money either at the Fed or as currency in their vaults. So that is the monetary base, the currency in circulation and the bank reserves. Those wind up being the liabilities for the central bank. And again, the assets of the central bank are the treasury bills, the government debt that they own. All right, so what is an open market operation? So an open market operation is a purchase or a sale of government debt by the Federal Reserve Bank. Normally, this is done through a transaction with commercial banks. So commercial banks are banks that mainly make business loans. The Fed never directly buys U.S. Treasury bills from the federal government. This way, the central bank avoids printing money to finance the government's budget deficit. So there's a sort of like roundabout process of increasing and shrinking the money supply that does involve expanding and contracting the amount of debt that the government has, but it's not direct. So the government can go directly to the Fed and say, we need money, here's some debt we're issuing, buy it from us. Like, that's not how it works. And again, it's meant to sort of shield us from that potential problem of like there being very irresponsible politicians in office that are just like print money as much as possible in order for me to finance whatever. So it's part of our system of checks and balances that we have. But ultimately, the federal debt that the Federal Reserve owns, like the government doesn't actually have to pay it. They just basically give it back to the government. They just take the money they need to run the Federal Reserve Bank from it, and then that's it. Like, it's not like the money is actually paid to the Federal Reserve, like, because it is part of the government. It's a really strange system, but again, it's all about trying to shield this part of the government that is trying to enact monetary policy from politics in order to then, not wind up in a situation where you're just politically motivated to print as much money as possible. All right, so let's talk about this open market operation and how it affects both the Federal Reserve's assets and liabilities and the commercial bank's assets and liabilities. So when the Federal Reserve buys U.S. Treasury bills from a commercial bank, then they deposit, whatever it is they're paying for those bills with into the commercial bank's account that they have. So they have that reserve account, and so then this increases their reserves, which then allows them to borrow, to lend out more money and increase the money supply. So again, when the Fed buys U.S. Treasury bills from a commercial bank, it pays by crediting the bank's reserve account by an equal amount to the value of the Treasury bills. So let's say there's $100 million that are being purchased. So the Federal Reserve credits the commercial banks with $100 million in reserves, which then become part of its liability. And again, the monetary base is made up of the currency in circulation and the reserves in the Federal Reserve. So the monetary base increases by $100 million. And of course, the Federal Reserve increases its assets of U.S. Treasury bills by $100 million as well. The banks lose those, of course, Treasury bills, so they lose $100 million in assets. But then they gain that $100 million in reserves, right? Which then they can lend out, which then through the money multiplier process winds up creating more money in the economy. And there's no change in the liabilities. Let's look at the opposite case where the open market operation is a sale of $100 million. So with the purchase of $100 million, where the Federal Reserve Bank is expanding the money supply. With the sale of $100 million in bills, it is contracting the money supply. So when the Fed sells U.S. Treasury bills to commercial bank, it debits the bank's accounts, reducing the reserves. So then the Federal Reserve winds up shrinking the monetary base by $100 million, right? You have $100 million in the reserve accounts of the banks. that is now being used to pay for the treasury bills that the banks are buying from the Fed. So then the Federal Reserve Bank winds up selling those and losing those as assets to the commercial banks. The commercial banks gain those 100 million in treasury bills, and their reserves are diminished by $100 million. So that diminishing of reserves also has a money multiplier process, and so then you wind up contracting the money supply by multiplying this by the money multiplier, which winds up being 1 over the reserve ratio under the very simple conditions that we talked about earlier. And again, there's no change to the liabilities of the commercial banks. The funds that are used to purchase the U.S. Treasury bills from banks are created by crediting the bank's accounts with new reserves, but the Fed can print money to pay for the Treasury bills when the banks want the additional reserves in the form of currency. So again, the monetary base is made up of the reserves of the bank and the currency in circulation. And so effectively, they are increasing the monetary base, regardless of whether they are crediting the bank's reserve accounts or actually printing money to pay for the treasury bills that they're buying. So the change in the bank reserves caused by an open market operation doesn't directly affect the money supply, but it starts a money multiplier in motion. An open market sale has the reserve effect, has the reverse effect. Bank reserves fall, requiring banks to reduce their loans, leading to a fall in the money supply. So again, if the Fed wants to increase the money supply, it's going to buy T-bills. So to pay for the T-bills, it's going to electronically credit the reserves of the seller. And with more reserves, the banks will then increase their loans. And then the money supply goes up as the money creation process ripples through the economy. So this is how, again, the Fed creates money via open market operations by, again, buying bills from commercial banks via open market operations. If the Fed wants to decrease the money supply, it's going to sell T-bills, treasury bills. So the reserves of the buyer will decrease. With fewer reserves, banks now lower the amount of loans that they're lending, and therefore the money supply decreases as the money creation process ripples in reverse through the economy. It's a complicated process, folks. Everybody should really know about this stuff, but you don't because it's complicated, right? But again, it is all in one chapter, so anybody could just read that one chapter anytime and learn it and figure it out. But there's a lot to understand there, so that's why a class like this is really valuable. And again, this is information that is going to affect you the rest of your lives, and you should know, just kind of keep it in the back of your pocket, like you know about the branches of government, how they work, and how bills become laws, and all this other stuff that affects your life. This is another one of those important things that affects your life. So again, if you're not going into business, you're not going into economics, you should know about this stuff just to be a more confident, responsible citizen. Of course, we aren't the only central bank. All countries have central banks. And in Europe, we have a monetary union between a lot of the European states that make up the Eurozone. And they have a European central bank that sort of governs that entire monetary system that is independent of the sovereign countries of their governments. So the Fed is, again, only one of several central banks around the world. In general, other central banks operate in much the same way as the Fed. That's especially true of the only other central bank that rivals the Fed in terms of importance to the world economy, and of course that is the European Central Bank. The European Central Bank, or the ECB, was created in January of 1999, so it's a fairly new institution because the euro is a fairly new currency that was established around that time. 11 European nations abandoned their national currencies and adopted the euro as their common currency and placed their joint monetary policy in the European Central Bank's hands. So it was a very controversial thing because they were taking a very powerful policy tool away from the individual countries and giving it to the sort of centralized governing body that sort of muddied the waters of like their sovereignty, which is very important to these European states because they have a lot longer history than we do as far as like their existence and their culture and all and their pride ultimately. And so this was really hard to get through. I'm surprised that it even happened, but the fact that it did happen is good, but it's also kind of a strange and volatile system because, again, it's not completely one government that's being represented. It is several very strong independent governments that are being represented by this body. And so there's always like this push and pull between the bodies, which doesn't make it the most efficient system. So the member banks, so each country had their own central bank before they joined this currency union. The member country banks that used to serve as central banks now operate like the 12 Federal Reserve banks in the United States. They provide various financial services to the local banks and businesses and conduct open market operations. In the Eurozone, each country chooses who runs its own national central bank. The European Central Bank's executive board is the counterpart of the Federal Reserve's Board of Governors. Again, that Board of Governors that has 7 members that are chosen by the President of the United States, where they have 14-year terms, but except for the head, which is chosen every 4 years by the President and has to be sanctioned by the Senate. So the ECB's, European Central Bank's Executive Board, their members are chosen by unanimous consent of the Eurozone national governments. That's a tough one to get accomplished, but they get it accomplished. The counterpart of the Federal Open Market Committee, again, that committee that is made up of the Board of Governors and the 5 presidents, the revolving presidents, besides the New York Fed president, who's a permanent member, but the 4 revolving presidents from the other 11 banks. So that Federal Open Market Committee that decides monetary policy, that conducts open market operations that we talked about, buying or selling treasury bills to expand or contract the money supply. So their analog, the same body in the European Central Bank, is called the European Central Bank's Governing Council. The European Central Bank's Governing Council consists of the executive board plus the heads of the national central banks. All right, so everything we just talked about is very important. So I expect you to know the structure of the Fed, how it works, how it conducts open market operations. These are things I expect you to know and be able to demonstrate that you know. Now we're going to talk about the evolution of the American banking system. This stuff is just sort of giving you history on how things developed and got us to this point. All I expect you to know from this portion of the lecture is just kind of like the terminology, the highlighted terminology. Beyond that, just kind of listen to the story of how these things came about. So to fully understand the American banking system, it's helpful to understand how and why it was created. So let's talk about the crisis in American banking in the early 20th century. We've had crises in this country even before that, and it's just the nature of a financial system. Unless there are enough controls, then greed generally tends to run rampant, and that tends to cause chaos, which then tends to create turmoil in the economy. So from 1864 until 1913, the American banking was dominated by a federally regulated system of national banks. So the national banks weren't themselves like part of the government, but they were able to issue currency. They alone were allowed to issue currency, and the currency notes they issued were printed by the federal government with uniform size and design. How much currency a national bank could issue depended on its capital. So again, how much assets they had. The system had an average of 1 to 2 banking crises per decade. So it was very volatile, and therefore a change needed to happen. It was difficult to shift currency around the country to respond quickly to local economic changes. Rumors that a bank had insufficient currency to satisfy demand for withdrawals would lead to bank runs. So there were a lot of issues during that time period. In part, just like being able to transport actual physical money around to places that needed it. A panic in 1907 that originated in New York was different than those that had come before, which prompted a change and led to a 4-year recession. Trusts which are bank-like institutions that accepted deposits but that were originally intended to manage only inheritances and estates for wealthy clients, had begun speculating in real estate and the stock market, areas of speculation that were forbidden to national banks. So these trusts that were created prior to this period started to have a lot more power than they were intended to have. They realized that they could become big investors, and so they did, but they were irresponsible about it. Again, they were less regulated than national banks. Trusts were able to pay their depositors higher returns, though, which made it an appealing option for depositors. So therefore, that gave them more money to be able to gamble with. So this panic in 1907 prompted a major dozen trusts to go under within 2 days. So a lot of money was wiped out very quickly. Fortunately, New York City's wealthiest man, the banker J.P. Morgan, quickly stepped in to stop the panic. So one of these robber baron guys, who actually wound up being not a terrible person, but let's just call him one terrible person, was able to help halt sort of this downward spiral of the economy. Once people were assured that they could withdraw their money, the panic ceased. Although the panic itself lasted a little more than a week, it and the stock market collapse decimated the economy. All right, so then there was a response to the banking crisis, which was the creation of the Federal Reserve. So in 1913, the national banking system was eliminated and the Federal Reserve System was created as a way to compel all deposit-taking institutions to hold adequate reserves and to open their accounts to inspection by regulators. This did not eliminate the potential for bank runs because bank reserves were still less than the total value of their deposits. In 1932, the Reconstruction Finance Corporation was established and given the authority to make loans to banks in order to stabilize the banking center. So this is when we started to have these policies that were meant to stabilize the economy and halt the propensity to have these bank runs. The Glass-Steagall Act of 1933 created the FDIC, the Federal Deposit Insurance Corporation, and increased the ability of banks to borrow from the Federal Reserve System via the deposit window. The problem was not solved, though, since borrowing from the Reconstruction Finance Corporation was a sign that a bank was in trouble. In March of 1933, emergency measures were adopted that gave the Reconstruction Finance Corporation extraordinary powers to stabilize and restructure the banking industry by providing capital to banks through either loans or outright purchases of bank shares. Economic historians uniformly agree that the banking crises of the early 1930s greatly exacerbated the severity of the Great Depression. So we already had the Great Depression going on that started in 1929 with the stock market crash. And obviously led to a lot more tough times. And then this made it worse. Monetary policy was rendered ineffective as the banking sector broke down and currency withdrawn from banks and stashed under beds reduced the money supply. So people started to hoard cash and not have it in the money supply, in the banks, which could then be lent out. So new legislation was needed to prevent future banking crises. So then another Glass-Steagall Act in 1933 separated the banks into two categories. We had the commercial banks that accept deposits and is covered by deposit insurance. So those are the banks that we bank with. And then you had investment banks like Goldman Sachs and the former Lehman Brothers and Bear Stearns. These are large investment banks that had a long history here but are no longer with us post-2008. So investment banks trade in financial assets and they are not covered by deposit insurance. So the Glass-Steagall Act was meant to sort of separate the gambling behavior from the non-gambling behavior so that commercial banks would just deal with loans and have more stability so that there wouldn't be a situation where there would be these potential bank runs that would need to be covered by the FDIC. And then investment banks can do whatever they want. They can be as risky as they want. These measures were clearly successful and the United States enjoyed a long period of financial and banking stability. As memories of the bad old days dimmed, Depression-era bank regulations were lifted. So the Glass-Steagall Act was repealed in the 90s, unfortunately, and that a lot of people credit the financial crisis to that because the separation of the commercial and investment banks was no longer valid. Then banks started behaving in risky ways, which we'll talk about. And that's what led to 2008. So by 1999, the Glass-Steagall Act had been so weakened that offering services like trading financial assets was no longer off limits to commercial banks. So in the 80s, we had what was called the savings and loan crisis. So the savings and loan is another type of deposit-taking bank, usually specializing in issuing home loans. The savings and loans were covered by federal deposit insurance and were tightly regulated for safety. The savings and loan crisis of the 1980s arose because Congress deregulated savings and loans, allowing them to engage in risky speculation. So when you hear about like bank regulation and like, is it good or bad? It's good. It's always good. If you don't have it, then banks and any type of large financial institutions that have a large impact on the stability of our economy start gambling with the money they have, and then that can lead to good results for them, but it generally will eventually lead to bad results. And it's generally the wealthiest class of Americans and other citizens in other countries that are proponents of deregulation, even though they'll make it seem as though it's more of like a, freeing us from the hold of government type of thing. So the intent of deregulating the savings and loan was to make them offer higher rates of return like banks in an era of high inflation. But they wound up incurring huge losses. Depositors in failed savings and loans were compensated with taxpayer funds because they were covered by deposit insurance. The crisis caused steep losses in the financial and real estate sectors, resulting in a recession in the early 1990s. All right. During the mid-1990s, the hedge fund, long-term capital management, used huge amounts of leverage to speculate in global financial markets, incurred massive losses, and collapsed. Leverage is a behavior where institutions finance investments with borrowed funds. So they borrow money in order to gamble, essentially. Long-term capital management was so large that it caused balance sheet effects for firms globally, leading to the prospect of a vicious circle of deleveraging. Balance sheet effects are the reduction of a firm's net worth due to falling asset prices. So if we think about the asset part of the T table, you see that the assets can lower in value, like the loans that banks hold. If the loans all of a sudden become bad, then the value of those loans winds up plummeting. A vicious circle of deleveraging means that asset sales. When assets start to plummet, it becomes obviously a sign that the institution is in trouble, and so people start trying to get their money out. In order for these institutions to pay out, they need to sell their assets in a fire sale, basically start lowering their assets more and more. So asset sales to cover losses, forcing creditors to call in their loans, forcing sale of more assets, and causing further declines in asset prices. So that's what a vicious circle of deleveraging is. As a result, credit markets around the world froze. So this was during the mid-90s. The New York Fed coordinated a private bailout of long-term credit management and revived world markets there. All right, and then finally we get to the 2008 crisis. So during the U.S. housing bubble of the mid-2000s, subprime lending spread through the financial system via what's called securitization. Subprime lending is lending to home buyers who don't meet the usual criteria for being able to make the payment. So there were like no-doc loans where you don't have to prove your income, and all sorts of like really easy loans that allowed a lot of people to borrow that really weren't able to establish their ability to pay back, and that wound up ultimately resulting in a bunch of assets, loans that were crap, that eventually wound up being nothing. But these loans were pooled into assets, securitized debt obligations, and via a process of securitization, a pool of loans assembled and shares of it sold to investors. So these CDOs, securitized debt obligations, collateralized debt obligations, were bundled and then sold in the market as like this other asset, but the underlying value was these loans, which ultimately wound up being worth nothing when folks started getting foreclosed on. Yeah.
assets or bundled together were worthless?
Well, that's the thing. It's like nobody was really looking at the loan documents. Everybody was just excited about like the value of these assets and like the fact that they were going up and people wanted them and you can make money off of them. So that's obvious. That's generally what happens in these markets. Like you get that ravenous behavior and they don't actually know what they're doing and what they're buying. So yeah, nobody really cared to check. And then if you think about it, like in these markets, like a lot of these transactions are electronic. So somewhere the documents lie, and whoever buys them does have a right to get those documents, but nobody was spending the time to actually go get them. They were just like looking at the numbers, right? So when the bubble burst, massive losses by banks and other financial institutions led to widespread collapse in the financial system. So the Glass-Steagall Act, which again separated commercial and investment banking, allowed commercial banks to then start investing in these CDOs. And these assets made up a lot of their assets in their balance sheet, which obviously ultimately wound up being worth nothing, which is what caused them to then be in trouble. People knew this was happening. People started withdrawing their funds. The FDIC, it started to become maybe potentially like unstable itself. There was legislation passed quickly to increase the budget of the FDIC in order to quell those fears, but it was a really crazy time, and things could have fallen apart. Even with everything I just talked about, all the checks and balances that we have in place, like it could have all fallen apart, and it is all due to deregulation. So to prevent another Great Depression, the Fed and the U.S. Treasury expanded lending to banks and other financial institutions, provided capital through the purchase of bank shares, and purchased private debt. So the Fed actually wound up buying a lot of these assets themselves. So regulation after the 2008 crisis, in July of 2010, President Obama signed the Dodd-Frank Act, Wall Street Reform and Consumer Protection Act. This gives a special government committee, the Financial Stability Oversight Council, the right to designate institutions as systematically important, too big to fail, and thus subject them to normal bank regulation, even though they are not traditional banks. So like investment banks, like Goldman Sachs, are now subject to this kind of regulation as well. It establishes new rules on the trading of derivatives. They must now be traded in exchanges so their prices and volume are more transparent. So there isn't sort of all this like shuffling around of assets where nobody really knows the value or the stability of the assets. All right, folks, let's take a break. We're going to take a 15-minute break today because I got a lot to cover, including returning exams. So we'll come back at 25 today, 8:25. Thank you, folks.